Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
AI voice technology firm a year ago. And thank you, NVIDIA, for making much better chips to create more realistic fake humans. To intro our blog, stockcheatsheets.substack.com. I'm Mike O'Connor, along with Local Advantage Mortgage CEO, founder, Aaron Montel, also Denver legendary radio personality, and Perma Bear.
It's semi-perma.
Not in that order. It was quite the interesting day today.
Mm-hmm.
By the way, this is called the Unfair Advantage Podcast. It is a kind of a accompaniment to a blog that I put out most days of the week, at least 4 or 5 days, where we show you some proprietary metrics about market conditions and relative strength trends, and we basically grade ETFs to help you make more informed decisions. But we are not in the business of recommending anything. We're not licensed as fiduciaries, let alone broker dealers. We basically pick things that we think are better than the market. A lot of the stuff we trade personally, but we don't tell you what to do because we don't know your financial condition. So have I covered our ass enough?
I think CYA is complete.
So today, nothing but good economic news. If you're employed, more than likely than not, employers are, at least for now, giving you that 4% bump or whatever you get in that bonus. Manufacturing, service sectors today both regurgitated pretty good survey data that suggested that the sectors are quote unquote on fire. And the market and NVIDIA had blowout quarter. I mean, just to give you an idea. Of course, I've got some typos in here, like Q1 2025. Well, maybe that is NVIDIA's quarter. You know how some companies do the weird stuff? So maybe this is correct. I just basically, you can tell I cut and paste some of it from the investor report. I didn't pay attention to it. But their revenue is up 18% over Q4 and 260% year over year. I think analysts were expecting something south of 516 per share. And there's a stock split coming, and there's even a dividend raise on the stock split of a penny a share after the 10-to-1 stock split. So all the conditions were there for investors to buy. But what do?
They bought, and then sold.
Or the retailers bought.
And right. The retailers were sold too.
Yep. So listen, now, one of the things about cheat sheets, we got our proprietary tailwind score, which is basically that is a proprietary metric, but there's nothing proprietary about what goes into it. It's a series of lagging and leading indicators, along with buying pressure, which is basically my version of shaken money flow. And you kind of put all those together, stir up the pot, and you get what's called a tailwind score. Basically, if it's green, it's good. Red, it's bad. And then there's, some leading indicators on the far right that basically can give you a roadmap of what's likely to come. And we map it all out in terms of what they all mean. And I guess what I'm doing today is because my sense was, and I don't know what you think, AA, that we had some signs, not full signs, mind you, but at least the precursor to a potential market turn. Might be nothing more than just a pullback after what I'd argue is a viciously overbought market.
Yeah. I'd like to see it get below the 5 weekly EMA, and maybe we can talk about a market.
That's
turn.
Exponential moving average. For those of you who don't talk technicals, AA is also a CMT, chartered market technician in training. We'll call you a CMTT. Or a CMTIT?
CMTIT. I like it.
CMTIT.
Yeah.
And so NVIDIA basically held up the Qs today, but their momentum, and now we're talking about factor 10. Factor 10 is nothing you're going to base a intermediate trend prediction on. But what it does is it gives you some headlights about what's likely to happen. Anytime you get a momentum score, which is basically it's an oscillator that is the rate of change. And this rate of change happens to be the shortest term metric. So it's what the day traders and the position traders who are just in and out within a couple of days are doing. And they were largely selling today and into the close. I guess the Q's held up a little better because of the tech is just a better relative performer. It's attracting a lot of investor capital. But I think the biggest tell AA is the RSP. Maybe you can explain the difference between the RSP and the SPY.
It's basically the RSP is the components of the SPY, but equally weighted, whereas the SPY is weighted capsize basis. So RSP is just every company carries the same weight.
Yeah, and based on our tailwind score, we're basically mildly bullish on the SPY in terms of market cap weight. But when you really drill down into it, it's just a few companies. The equal weighted is actually dipped below 40, which between 30 and 40 on a tailwind score, that's bearish. So that predicts that the coming weeks to months, at least weeks, are not going to be good for the market. And when you couple that score with then factor 9 and factor 10 are near term, like that's our 2-week time frame and our 3-day time frame, both in the danger zone, with the long-term market forecast, which is factor 7, also kind of not supportive, meaning it seems to me that this intermediate trend is going to do what the market forecast says it's going to do, which is you can have a short-lived intermediate trend when you have conditions like this. Yeah. And we may see that. So we're all eyes are going to be on the breakout and whether that breakout level holds. We're not going to show charts today. But for those of you who've been following my blog, you know that we definitely are either going to fall back and retest a level that the market had hit its head on a few times or not, right? Or will fail. And I guess we could fail by the end of the month, which would be a monthly bearish candle or failed breakout.
Which would be significant. And a few things that your data picks up on, but I think is worth mentioning specifically is the lack of breadth in the market.
The RSP versus the SPY is the best indicator of that.
Great example of that. Yep. And also the number of I read today the number of stocks in the S&P above their 50-day moving average has fallen to below half. So there's not a lot of breadth in the market. Lots
of way to skew the data that suggests the rally has been thin and defensive, I'd argue too.
And the other point I wanted to make is volume, which we've commented over the last, I don't know if we mentioned it last week, but you and I just have mentioned the last several days, 2 weeks, volume has been relatively thin.
So right now we have one of two factors for the bearish market turn. We got the momentum in near term, factor 9 and 10 in those danger zones. And that if that persists, eventually the intermediate term, factor 8, which is here, right now, very bullish. So the momentum today is not enough to turn an intermediate trend. But you're watching for that. And then you're also watching for weaker buying pressure that's shaken money flow. Right now, it's pretty good. Factor 4. Pretty good in the indexes, but it won't stay that way if we get more closes like today, right? So you think of this as potentially day one, but certainly listen, if you're acting on this information to go short, you're very aggressive and it's a very risky trade. You need more confirmation, or at least I do as a trend follower. And basically my version of going short is get out of the market.
Right.
For my weeks to months stuff.
It's hard to short.
Yeah. You do it. But you're not looking at data like this. This data does not support short sellers.
No, it doesn't.
All right. So sectors, tech, communications, basically communications, XLC, Google earnings. It's basically three letters for Google earnings. That's what has been driving XLC. And XLK, obviously, you've got the broader AI play. And we talked about it, social media stocks, the political infusion of capital. You can almost trace the where the market is hot to exogenous events between the meme stocks, the AI craze, the influx of spending capital into XLC. What else? There's one more. I'm just not thinking of it.
I can't think of it either.
A little defensive turn too.
Yeah.
XLV, XLU, and XLP, borderline. They all have bullish money flow.
Mm-hmm.
Very bullish on XLU.
And
that's
defensive.
Utilities, staples,
Yeah.
healthcare.
Yeah.
They're not quite at the market level. That's because basically it's the market cap weighted stuff like Google and NVIDIA that's pulling up the market cap weighted spot.
Yeah.
But you mentioned this. We're going to talk about two things, but XLI, what's a subcomponent of XLI? So that's industrials.
Industrials. Yeah.
And then there's a subsector, which we'll get to in a minute, underneath industrials that we think of as a bellwether for the market.
Mm-hmm. Okay.
So XLI is danger under 5. And the consumer, the XLY has been declared dead for weeks now. And that's got an 8 on a tailwind score. So broad market, healthy market, not with retail stocks. And what I'm consumer focused, not retail so much, but consumer focused stocks in distress. And you're getting a lot of companies like Starbucks saying people aren't coming in for $10 coffee anymore.
Right. Right. Target had a big move down after earnings. Yeah. A lot of the retail brands are definitely feeling some headwind.
Yep. Capital One, 5% default rate on credit cards. That's the low end of the credit card market, but we're starting to begin to see the shift of the persistent higher prices. Those who aren't invested in assets aren't doing nearly as well as the ones that are.
Right.
Yep. And energy, natural gas has rotated into favor according to my blog yesterday, but the oil has not sustained itself. And while energy services still looks good, the XLE overall doesn't.
I've noticed that also. I find it interesting that energy has lagged, but it is in fact what's happening.
It's hard to have an economic boom without basic materials, although I have some evidence that suggests that part of basic materials, the metals, the industrial metals, that's a little hot right now. It's overperforming the market. So put a pin in XLB, but XLY, XLE, XLB, you don't have those things. And again, my indicators, these are leading indicators. Like if you're waiting for the 50 to cross under the 200-day moving average to consider yourself bearish, you're not going to get that from cheat sheets data, right?
Okay.
This is for trend following traders who are willing to round trip within a year. So just remember that. This is our discretionary, I call it the funny money trading, the stuff that, hey, listen, if the market blew up and you got pantsed in your portfolio, you're not going to ruin your retirement or your kids' college savings, right? You put a portion of the money you have or had until you went into credit card debt into the market to, we're not scalping, but we're in this thing for, a month when the market is trending, but it has that long-term intermediate forecast kind of pressing down on it, meaning it's not going to be an extended trend, or you're riding trends for months.
Yeah.
But generally not years.
Right.
With the kind of trading that cheat sheets is set up to deal with. It's vacation money.
Right.
Yeah. And so subsectors, you can see kind of the tech theme. Aerospace and weapons, that was what I was trying to say, is that.
Oh, okay. Defense. Yeah.
Yeah. Congress has allocated billions for, various global conflict theaters and weapons production. And that's all money being fed into the U.S. military industrial complex. Right.
And I think sometimes people don't quite connect those two dots that these defense spending packages,
they're stimulants.
Yeah, they're absolutely. They're stimulus to the economy. They go through Northrop Grumman. They go through Lockheed, and then they find their way overseas to whatever their destination is.
Right. But after U.S. workers are building bombs to drop on Russians. Semiconductors, that's all about the artificial intelligence boom. Capital markets is, that's what those guys do, right? But all these are kind of showing signs of danger today. So these have been some of our biggest performers, but this might be nothing more than an intermediate oversold or overbought dumpage, right? It's like time to get out. And institutions may just be sensing that after the NVIDIA blowout numbers today, it can't get any better than this. The market broke out. It's really overbought. Let's just sell this stuff.
Yeah.
And that could be it. But it's all tech.
It's all tech.
Industrials, semiconductors, financial services.
And yields are rising again in the background, which also causes me some concern.
Yep. All right. And so this is the middle tier now. The All Country World Index. Not quite as good as the SPY anymore. And there's XSW. So it's all tech, telecom. And then now let's start to look. So banks, insurance, so financials have fallen apart.
Yeah.
Oil services, of course, we're just not getting the love from oil and gas anymore. The price of oil is not. And then Biden released 1 million, or is going to release 1 million barrels from the strategic petroleum reserves. I'm assuming that's just an election play. Healthcare equipment, biotech, regional banks. That's a little bit of concern.
And look at TLT. Speaking of rising yields, TLT down is yields up, and
bonds have been bearish forever.
Yeah, they had a nice little bounce in the last couple of weeks off of a not really, but some call surprising CPI report, and now they're giving it back.
XRT is our Starbucks Target ETF, and then we have transports.
Yeah,
you're the one who brought this up. I don't see worse scores than this.
Yeah, and transports is interesting because it's. I'm trying to remember back to my earlier studies. It's a component of Dow theory, right? So
that's right.
As
so goes transport, so go the markets.
Yeah, and so that's something to watch. And the fact
this is
that
FedEx, UPS.
Yeah. And by the way, if you break out and look at those, they're looking pretty gnarly the last couple of weeks.
Yeah, you're not only bearish relative strength, very bearish buying pressure, meaning institutions have a FOMO level of liquidation going on right now. So these would all be leading indicators of an economic slowdown.
Yeah.
And here's the tailwind. And so 30 to 40 is the worst case scenario. Under 30, sometimes the selling is, listen, market can go down for a long time. And I don't think folks who've been in the market the last 15 years have any idea. They think, hey, man, what's the worst thing that happens? 9-month, 3-month bear markets? No, they can last 2-3 years longer. Remember, we went through 2001 or 2000, I guess it was March 2000 through, I guess it didn't get better until about 2004. And the NASDAQ lost 80% of its value. That was my early days trading.
Yeah, I wasn't an active trader at that time, but I was in 2006, 7, and 8. So
right. And 7 is when the market started going down. People didn't start feeling bad about, the Main Street didn't feel the impact until late 2008, really more in 2009. It was 2009 to 11.
Yeah.
Was really the peak of those long unemployment lines and people walking away from houses and mortgages. And it was awful.
Yep.
So we haven't had one of those in a while. We've had flash crashes and COVID crashes, and 2022 bear market, I guess, is the worst thing that's happened in the last 15 years.
And since then, not to go off on too much of a tangent, but since then, the one thing that's been the constant is intervention, and how much more intervention can there be? I mean, probably more than we would ever imagine, but at some point, right?
I'd argue this chart makes that problematic. Because listen, there's always something in the commodity space that's rallying, but whenever we see this cost that goes into the stuff that Americans want, wheat, platinum, base metals, wood, all cranking here. That's what's getting the grades. Silver, which is an industrial metal. Gold, you could argue, is an industrial metal, although the money flow in gold is not great. And then when you see, right now, at least coffee and lithium and sugar are cheap, or on a relative basis.
Wow.
But I started to think about so let's take PPLT, for example. That's the platinum ETF that was grade A. That was our top rated ETF in our relative strength report. You can, by the way, read yesterday's blog if you want to understand how this all works. Okay. I explained it last week in the video. But grade A platinum, that means, money flow has to be FOMO level. Trends in the intermediate and long term have to be good. And relative strength rank, like this is basically graded on a curve. You have to be in the top half in this, what we call the sweet spot, the 3 to 6 month period, and in the top third in the shorter time frame. So you have to be not only strong, but gaining momentum. And so it's a tough putt to get an A in this system. And there it is, money flow at 0.32. Look at all the stuff that platinum impacts. Medical devices, chemicals, which is everything, right? It's most of our consumer staples probably touch platinum, jewelry, electronics, catalytic converters, and auto. And then when you think about base metals, so DBB, B rating here, number 2 overall in the 3 to 6 month, pretty persistent up here, 0.1 money flow, just not quite a 0.2. That's the only thing keeping it from being an A. Look at this: copper, aluminum, nickel, zinc, lead, tin. That's that hits just about everything. Anything that comes in a cardboard box from Amazon probably has one of these base metals in it.
That is manufacturing. Stop. Yeah.
Full stop.
Yeah.
So the cost of inputs going up, producers pass those costs on. When they can get away with it, they just rebase their profit margins off of those numbers. Consumers get killed. And eventually the rubber meets the road.
Right.
And so it feels to me like it's March 2007. And the market didn't start feeling the real pain until March 2000 or August 2007. That was our first big drawdown. And then, of course, there was an equal and opposite reaction beginning in October of 2007. And we rallied until Christmas, and then we crashed through March from basically Christmas 2007 through March 2009, the market went one way.
One way. Yep, down to 666.
Yeah, right, down to 666.
That's what it was,
right. Yeah. So I know that I'm not supposed to be this bearish prognosticator, but I've been feeling this for a while, and the data has backed me. There's only been a couple of periods in the last year where we've seen a broad-based rally. If there was a brief period of maybe a month where the equal weighted S&P 500 ETF felt pretty balanced, like everything was rocking, but it didn't last long. For the most part, the Magnificent Seven drove last year's rally, and this year's been slightly different. But I think that I'm concerned about and the higher the market goes, the more concerned I get. And listen, we've got to have a correction at some point.
Yeah.
And who knows when it will be. And the market can be irrational for longer than I have money. So I'm not going to short this thing. It's going to be nothing more than a retest of a breakout.
It's really hard to short. And I'll say, and I mentioned it before, but it really, to me, it's a really important sign is the lack of breadth and volume. Because price follows volume, as they say, right? And there's very little volume. So there's not much conviction behind what's going on.
AA runs a blog it's meant to bolster his mortgage business, but I think it's great because what you do is you forecast bond movement and hence interest rates, because bonds, when they go up, interest rates go down and vice versa, right? Yeah. So when the Fed is buying bonds, that's a good time to be thinking about buying a house. So yeah, you're a mortgage broker, but your blog is really not about that. I mean, you're not trying to sell mortgages in your blog. You are essentially forecasting the bond market to help your clients lock rates at more advantageous prices.
Yeah, that's the idea. I'm just trying to give a little insight into how that particular market works for people who are in that situation or people that just find it interesting. So that's the idea, is just a peek into the bond market and how it interacts with the mortgage market.
And StockCheatSheets.com is nothing more than a regular retail investing schmoes system for trying to build up capital for vacations that I otherwise couldn't afford at my standard of living based on my salary. And I've been successful more years than not. Now, when the market goes down, I'm no genius. Maybe I go down less, but I go down, and I don't go on Silver Seas cruises. But we've had this relentless bull market, and so I've booked several vacations here thanks to my trend following system, which I share with you mostly for free. If If you want stock picks, it's $5 a month. So you can go to stockcheatsheets.com. I'm Mike O'Connor. You are AA, and this is the Unfair Investing Advantage podcast. We'll see you soon, Double.
Thanks, Mike.